Here we go. Hello, this is Guy from My Real Estate Advisor doing a quick podcast today with Gareth and Ty, talking about Gareth's business. He's now working with Ty as well. And yeah, he's going to introduce himself and his business and just give you a bit more background on what Gareth gets up to as a mortgage broker. So, Gareth, over to you, mate.
Yeah, thanks, Guy. Thrive Financial Group is our company. We're nearly 2 years old now. We started in August of 2024. So things have been really good. We've seen a lot in that 2 years with the market and the way it's moved. Um, but I've been in the space for about 10 years now. And before that, I was a financial advisor for about 3 years. So I've kind of seen both sides of the fence and have been able to apply kind of both sides of that education too to help our clients. So it's been really good. It's been interesting.
Nice. And Ty's new to your business. You're expanding the business at the moment, so you, Gareth. Is that what you're
Yes, yeah,
planning to do with the
definitely.
business?
Yeah, Ty, I'll let you field that one, mate, and your history, where you've come from. It's pretty interesting.
I'm a new to industry broker. Been accredited for a few months now and been working along with Gareth, sort of under his guidance, learning the ropes and whatnot. So I bought
Yeah.
my first home in end of 2024. Went through a broker and just loved the process. So that's kind of inspired me to go down this industry. Was actually a
Yeah.
professional swimmer, recently retired, and then just trying to find the next step. And this all led me to here. So it's a
Yeah.
steep learning curve, but it's been great. So yeah.
Happy days. Cool. All right, great stuff.
I
Well,
also
let's
love that
well,
you can retire in your early 20s too. I love that. That's my
yeah. I
favorite
know
part
I've
of.
retired. Yeah, I've had to
Yeah,
retire. I've
yeah,
got
yeah.
got some
It's a
mid
bit of
twenties
pain.
now. That's
Not
it.
indefinitely, unfortunately. You still got to wake
Yeah,
up and go to work, but
yeah,
retiring from anything in your early 20s
yeah,
is always a
Yeah,
win, I think.
that's
yeah.
good. That's a win-win for everybody. Yeah, I wish I could
Yeah.
retire from something. Okay, cool. So we'll crack on with the questions. So we're just going to do some questions about the market and how things are going at the moment, and then yeah, we'll have a bit of feedback and yeah, a bit back and forth. So market trends at the moment. What do you think some of the biggest shifts are that you're seeing right now in the Australian lending market, and how's that impacted their borrowers? That's question
Well,
number one.
yeah, probably no surprise if you haven't been under a rock for the last 5 years, you'd be aware of just the cost. Everything has
Yeah,
accelerated. I'm seeing we work pretty closely with a few different builders. That's probably 60 to 70% of our channel, which obviously we'll touch on. But
yeah,
they do also provide a lot of insight into the industry. So it's good on both fronts to work with a builder. But they're seeing metrics of about $2,000 a week at the moment in property growth here in Queensland. So we've got a presence everywhere in Australia, but probably
yeah,
60% of our clientele are here in Queensland. And
yeah,
yeah, $2,000 a week is pretty standard at the moment. And
mm,
we've always, if you've been in Queensland for long enough, which a lot of our clients have, some haven't, Logan is an area that's always been considered quite low demographic. Well, it's
yeah,
funny how a few years can change everything because I was actually watching the news the other day and they said that Logan's the fastest growing suburb in Queensland. So it
oh
just
yeah,
goes to show, yeah, people that had a hot tip potentially bought into Logan 6 years ago have probably accumulated about $500,000 in equity without
oh
having to
yeah,
do anything.
yeah.
So
It's,
yeah,
it's crazy. Yeah,
the
yeah,
market is just it's running at the moment here in Queensland. WA is performing really well.
mm,
Victoria's a little flat, which we know, but yeah, it's crazy. It's running really hot at the moment.
yeah, yeah, for sure. So next question, borrowers mistakes. What are the most common mistakes people make when applying for a home loan, and how can you help them to avoid them?
Yeah, the most common mistakes I hear of, because I like to back my fellow brokers and think that we're all doing the best that we can. But the most common mistakes I get from my clients, at least, is that they went to a bank first. Um,
Yeah,
it's an
okay,
obvious decision. You've banked with XYZ Bank your whole life. You think logically that that's where you should go for a home loan too, but that one bank can't provide other options. So you kind
no,
of pigeonhole yourself into what might not be the best option for you. So the biggest mistake I've experienced as a broker, because again, I like to back myself in that we do a good job for our customers, but would be that.
Yeah.
And, the clients that I've spoken to that have come from a bank or tried with a bank, I had a client come to me once and say that he'd been knocked back by 3 different banks. I had
Wow.
him
Okay.
approved for a home loan about a month later. So that's the common mistake, is that people go, oh yeah, I've been with this bank forever, they'll approve me,
Yeah.
and they don't, and they're completely disheartened. They've
Yeah.
missed their opportunity to get in. They've given up. So
Yeah.
it's easy to do, but that's probably the biggest one I've seen.
Yeah, I think you're right. The thing is that a first time buyer doesn't really know the difference, and they're just going to go, oh, well, I'll go to the bank. The bank, I could probably get the loan from the bank that I'm with, and that's all they
Yep,
know. They don't perhaps know much about brokers and things anyway.
definitely.
So
Yeah,
until they start to go through that process, they've they've never even heard of a broker, depending on what industry they're in themselves. Might know
yeah.
nothing
No,
about it.
I get questions all the
Uh,
time about what I do and my services and how much I charge. And it's always
yeah,
enjoyable for me to big smile. I don't charge anything. And so that's
yeah,
another bit of knowledge that not a lot of people have, as they think, oh, well, this
yeah,
person's helping me, they're going to provide me with an invoice. It's just not the case. Brokers, which again, I think is why our channel is really starting to take over the banking channel. I think the last time I looked into it, we're about 67% of their business, the broker channel. So there's obviously a cause to that, and it's people are starting to wake up and go, well, hang on, I've got this person that's going to go and look at 56 lenders we've got on our panel at last check. Could you imagine
yeah.
jumping in your car and driving around to 56 different banks? You'd spend your
Yeah.
whole deposit
Oh
for a
no.
house. So,
Yeah. Yeah. On your petrol. What
yeah.
was I going to say? So next question, rate strategy. So should buyers think about fixed or variable rate in today's environment? So what do you think about that? Because that's like an ongoing thing, I suppose.
Yeah, that's a tough one too, because that's where the crystal ball comes into it, right? And I've
Yeah.
had people really win by fixing, and then I've had people really lose by fixing. So you've
Mhm.
got to really sit down and explore, hey guy, what do you want over the next 3 years?
Yeah.
Because once you fix, you're locked in at that point. If you want to
Yeah.
sell, if you want to refinance, going back to my previous comment about the property market. A lot of
Yeah.
my clients, our conversations tend to, and I think everyone is this way inclined as well. They want to build a property portfolio. They've seen
Mm.
Australia. Our bread and butter investing is bricks and mortar, right?
Yeah.
It
Yeah.
always has
True.
been. It's what
Yeah.
foreign investors come to Australia for, is to invest into our real estate, right? So a lot of my clients are the same. That, hey, I want to, I've read this book. This person's gone from 1 to 10 properties in 2 years. How do I do that? So if that's your mindset, fixing's dangerous, right? Because at the moment, like I said, $2,000 a week, $150,000 a year in equity that you're building. 12 months
Mm.
later, you can reapply that to buy an investment property. But if you
Yeah.
fixed and that's your goal, well, then you're kind of locked away, or you have to pay a break cost to get out of that fixed contract. So
Yeah.
there's no right or wrong answer. It comes down to the individual and what we've explored together and what they're looking for. So you can
Yeah.
do both, right? So some people go, look, I've got substantial savings, or I've got an inheritance, or I've got some sort of money coming in. I want to be able to
Mm.
utilize that as best as I can. Cool. How much have you got? Oh, I've got this much. All right. Well, let's make that part of your mortgage variable, so you can chuck all of that money into that variable split and completely offset the interest. And the other
Yeah.
component will fix it so that you've got those guaranteed repayments each month, and you don't kind of have to worry, the set and forget model. So there
Yeah.
is like no right or wrong. I like both, but it comes down to the individual and what they want.
Yeah. True. Well, I mean, the variable thing is it's a bit of a gamble if it's going to go up or down. Fixed is, well, you've got to be really serious about that if you're going to
Yeah.
move
Which
forward for that
government have we
future
got at the
uplift.
moment? Yeah. And, which have
Yeah.
we got, Liberal or Labor, and who's going to do
Yeah.
what? So it is
Yeah.
such a guessing
Exactly.
act. And that's where that crystal ball comes into it. Because, we could throw out this government in the next election, and all of a sudden interest rates start coming down, and you fixed yourself in at a higher clip, not
Exactly.
knowing was around the corner. So, there's obviously risk versus reward in every decision. But I think as long as we explore what you want long term, 2 to 3 years, you'll come out with the right, game plan.
Yeah, for sure. So next question, broker value. So what's the biggest misconception people have about mortgage brokers, and what's the real value that you provide?
Yeah, well, I guess
So,
to repeat what I said, a lot of people think that we're a paid service, and don't get
mm,
me wrong, there are brokers out there that do charge a fee. Not
yeah,
everyone works for bank commission, but for brokers, we're paid by the lender. And since the Royal Commission, 2009, I believe,
yeah,
every lender on our panel, right, we work under an aggregator called Connective, pays the
yeah,
same commission. So for me, if I
right,
take you to ANZ or to Macquarie, there's no financial benefit between one or the other. So
yeah,
again, I wasn't a mortgage broker back then, so I can't speak to what the industry was doing, but I can certainly see the forest from the trees, and that there would have been some, bad players putting people into bad mortgages because they got paid more. We
yeah,
can't do that anymore. So anything that we promote to our customer, we don't see any better or worse financial gain from it. So I guess the
yeah,
misconception there is that, we're going to make more money because we put you with this lender who gives us more. Because I have heard people ask me that before, right? And then again, the fee for service. So I'm not going to, again, throw shade at any brokers that are charging a fee for this. Good on them. If they can still bring in customers and get paid twice, great business model for them. For us, we're a little bit more transparent, and I would like to say ethical, in that
yeah,
we only get paid if we deliver a result, right? It's as simple as that.
yeah,
If we don't get you an approval, we don't get paid. So it's obviously in our best interest to get that client the result that they need. So everything as well has got to be provided to the client, compliance documents. This is the commission that we'll earn, and all the rest. So, I don't get too many people, sort of doubt the services that we provide, but that is a misconception, I think, across a broader market, that mortgage brokers are a
yeah.
fee for service.
Yeah, I think you're probably right there with that. Most things, I mean, if you're thinking that you're going to go talk to a solicitor or an accountant or whatever, people are going to assume mortgage brokers will be in the same kind of boat as that you're going to get
Yeah.
charged for that person's time, regardless of whatever. You know what I mean? So there probably is a bit of a misconception on that one for most people.
I think it's really what stands out about mortgage broking as a financial service compared to anything else. And it's, I've always said, yes, we are in sales. Technically, mortgage broker is a sales role, but
Yeah.
I've always said I'm more of a facilitator than a salesman, right? I don't try and sell you a product. I don't work for one lender. I work across 50 plus.
Yeah,
so
you're Switzerland. You're basically neutral on this.
Yes, I am not. I am very, very neutral. So, you can be a client who goes, no, I want to go with this lender. I've been with them forever. I like them. I don't know why anyone would like a lender. They're all banks. They're all making, record profits while we're all struggling. But that's a story for another day. But yes, we can do whatever the customer wants at the end of the day. But I won't even say 99 out of 100. 100 out of 100 times I ask that question, people say whoever's got the best rate.
Exactly.
I don't think people care too much about loyalty anymore with banks. It's just, I'm hurting. I need to reduce my rate, or I need the best rate possible. Can you do that for me? I don't care who the lender is.
It'd be the same with anything else, like insurance, for example. Like whoever's the cheapest, I'll go with that insurance company. It's going to be the same kind of thing. Okay, cool.
$3 a litre fuel, you don't really have an option, do you? You've got to go for the best value.
Yeah, exactly. So next question, investor lending. For property investors, what lending strategies are working best right now? Now, I'm not too sure about this question because this sounds more like a real estate question than it does a finance question, but
No, I definitely have some, thoughts on that too. So I guess just going back to what I said previously too, where we work with a few different builders. I started working with builders around 2017 when I was working for another company as their finance manager. But where I've really seen, if you compare apples for apples, the difference in investors, those that build against those that buy established, those that build tend to make in the same time double the equity of those that buy established. And sort of my conversation piece around that, and you probably agree with that too, guys. And I say to my clients, I say, look, if you go out and you stand in a, display village and you've got one house that's already built 4x2x2, and you've got a vacant block of land next door that's going to have the exact same house on it, which one is going to be more affordable, right? And you don't have to be a rocket scientist to work that out. The patch of grass is going to be more affordable because they simply cannot sell it for the same value as the already built property. I always call that, I call that an inconvenience factor, right? If you're willing to inconvenience yourself and go through that process, because it is a little bit of a delayed, gratitude, you make a lot more money. Yeah. And so, we tend to do a lot of modeling for our investors around that and say, well, look, you're an investor. I already know what you want. You want to build a property portfolio. Otherwise, you wouldn't be an investor. You would have bought a home. You would have sat on that like the old Greeks did in Melbourne, who've had one house since the 1970s. It's completely paid off. That model's great. It doesn't really work that well anymore, unfortunately.
No.
But with our investor clients, what we tend to do is just like a rinse and repeat model. So they build, it's typically 12 months from signing of the contract to getting the occupancy, which is where you get the keys from the builder. On that day, depending on how motivated the investor is, but typically they're all pretty motivated to see money, we then do another valuation and we go, hey, look, this is what you paid for when you purchased the property. This is now what it's worth. Congratulations, you've made all of that gap in the middle. And it was always 100 to 150,000. It's now 150 to 250,000 in 12 months. So it's really easy for me to come back to that investor and say, you've just doubled your annual income by holding on to this asset, and you can now go and bundle that equity up and do it again. And it just becomes a snowball. 1 becomes 2, 2 becomes 4. And I've got clients now that are rolling into sort of their 5th property off their first. They did a construction as their first home. Once it was built, we just implemented that same model. Bundle the equity, go again. Once that's built, bundle the equity, go again. And they're going into 4th and 5th properties on dual income with children. There's nothing special about them. They're just, they have a goal, they know what they want, and they're willing to allow us to implement that strategy for them.
Yeah. No, that's really, really good. As I say, and to be fair, with the way things are with people's pensions and stuff like that, they're probably the best thing you possibly could do for them is to help them get to the point where they do have 5 properties, because then when they come to retire, they've got some money to retire with, haven't they, if they sell those properties?
Well, we've got a lot of self-managed clients too, guys. So we've got a lot of investors that invest in their super. So that's another area that we are in. I laugh about it and say that reluctantly I do super because it is quite difficult. Super lending.
It's a lot harder. Yeah, it is a lot.
It's
harder.
Very regulated. Yeah, it is very regulated. But fortunately, I've done it for long enough now that those hurdles are a distant memory. But we have quite a lot of clients that will buy in their super. They buy property because, again, my conversation around that is, okay, you're in an industry or a retail fund like Bus Q. Do you know the person who's managing your portfolio? Do you know what they're investing in? Do you know what they do on a weekend? No one does, right?
No.
You use your super to go and buy. You use your super to go buy a brick and mortar place. I mean, obviously, I wouldn't recommend it, but you could buy it next door. You could go and put your hand on the wall anytime you want. This is my super. Now you go and touch it. I know what color the bricks are, So I'm always a big advocate for self-custody as well. I don't like having to rely on other people. I don't like relying on fund managers that I've never met. Yeah, I don't know what they, ethically, where they draw the line. I would rather myself have a brick and mortar investment in Australia that's in my superannuation, that when I retire, I can sell that property. I know that the market here is always increasing, even in the periods, as you would know too, where it doesn't. 10 years ago, property was half what it is now. What's it going to be in another 10 years? So we play a lot in that space. investing in your personal name and investing in super, so we have a pretty broad range of that too.
Cool. So next question, first home buyers. What advice would you give to first home buyers trying to enter into the market in 2026? So
Don't talk to a bank. Yeah, don't talk to a bank. Again, probably
Okay, fair enough.
got to hear me say that a lot, but there's so many schemes and like government grants that are available. I still talk to first home buyers on a daily basis that don't know that. Right? They just come to me with the old, can my mum go guarantor? Can my dad be guarantor? How much deposit do I need? They've got no concept of all of these grants. And if you've worked in Australia for long enough, you've probably, thought about the ATO more than once. So my approach to that always is we've all paid a fair amount of tax in our time. So if you're a first home buyer and the government is saying, hey, we can give you, first home owners grant in Queensland's $30,000.
Yeah.
If the government's giving you $30,000, you take it. You don't ask questions. You take it, you buy that home and you get into that home and you start making equity straight away. You start paying down that mortgage straight away. So the first home owners grant's one, right? There's so many other grants and concessions. We could sit here all day and go through it, but the other sort of the other side to that too is I get a lot of people that, because the market has run away, they can't afford to buy something to live in. So more so in the last 12 months than ever before, since I've been a broker, we're doing rent vest strategies. So look, right now your income's not enough, right? It's not going to be that way forever. You're a young person. You've just, entered your career for the next 40 years. You are going to progressively make more and more money. But at the moment, the market's going crazy. So if you go and sit on the sideline for another year and try and save 10,000, 20,000, sorry, buddy, the market's already moved 50,000. You're worse. You're worse in 12 months than you were today. So what we're starting to do now, and I think lenders, they're not idiots as much as I, like to say that, I'm the Robin Hood and I'm here to help the little guy. Lenders are not idiots either. And a lot of them have just come out with new policies around increasing their loan to value ratio. You'll see this a lot when you talk to a broker, an LVR. With investing, you could only ever go to 90%. They wouldn't allow you to go any higher. They've just lifted that to 95. So basically the same lending rules now apply for if you're buying something to live in as if you're buying something to invest in. So again, going back to like first home buying, what I tend to say is, look, you can't afford to buy something to live in right now, but you're living at home, you're renting, whatever it might be. Let's look at rent vesting. Go and build an investment property. You can put in a 5% deposit, and in 12 months' time, you've had a pay rise, or you've increased in your earnings. Plus, you've now got 150, 200K of equity. You can either keep that investment property, hopefully, because obviously we want all of our clients to build a portfolio, and you take that 200, go and buy another property, or you can sell it. And in 12 months, you've probably doubled your annual income, and there's your deposit to now buy something. So we're seeing a lot of that now where clients are starting to go, all right, well, I can't buy anything to live in Queensland because it's too expensive, but Melbourne's great at the moment. I might go and invest down there. And in 12, 24 months' time, I've got that deposit that I need.
Yeah, that's exactly right. I actually said that to somebody today as well. The chap was renting a property and stuff, and I said, well, if you buy the low end of the markets, even if you just buy an apartment or something like a one-bedroom apartment somewhere, anywhere, it doesn't matter. If you hold on to that for the next 2 years, take the equity out of it, and then you're afford to buy your real house that you're going to live in and just keep renting where you are and whatever. But even if you buy the really, entry level, I don't know, $300,000 one-bedroom apartment somewhere in the middle of nowhere, I don't know. It doesn't really matter. The point is that it's going to go up anyway, and you're going to have equity in it, and that will be your way of, getting into the market properly to buy your own house to live in instead of keep renting all the time.
You can almost guarantee at the moment that the property is going to go up in value more than what you can save.
Yeah, way more than what you can save there
Way
because
more.
the
Yeah,
cost of
yeah,
living's sky high as well. So you've
yeah,
got that. You've got two things going
exactly.
against you. It's trying to save
Yeah.
and the cost of living going up as well. Like
Well,
I'm
yeah,
just about to get an EV, right? I'm just about to get an electric car just because the petrol's gone up that much. I thought, you
yeah,
know what, I need a new car. I'm not going to
yep,
buy another petrol one again.
yep,
It worked out something like $40 to run the EV versus $200 or $300 for the petrol.
yep.
So,
But I guess,
cost of
just
living.
tying that back into a first home buyer, right? They're usually in their early 20s, early 30s. They can't afford to go and buy a new car just to try and save money on fuel. So this is why, like, for you and I, have been around. We're a little bit older. We're a bit more established. We can
Yeah.
do those things to help cut costs. First home buyers don't have those same ability as what we do. So, like you said,
No,
you agree. Obviously, I think most people would agree. Get into the market now. Don't wait, because if you
I wouldn't
wait,
wait.
goalposts are further. They just go
Yeah,
further and further. So
it isn't
yeah,
worth it. So
no,
we've only got about 10 minutes left. So we'll try and
that's
whiz
right.
through these last few questions pretty quick. And then, yeah, we'll call it a day. So, refinancing. When should somebody seriously consider refinancing? What signs indicate they're paying too much? So,
Well,
refinancing.
again, yeah, that's a how long is a piece of string question, because
Okay.
some people might not want to refinance, right? But for us, we
Yeah.
have reminders every 18 months. So every
Ah,
18 months, you're going to get a call from me. How's your mortgage going? How's the rate? Let's do a review. Again, everything we do is for free anyway, right? That's part of our service, that all of our reviews and work that we do is all free of charge. I've never contacted a client and said that, and they've responded negatively. Oh yeah, sure, I'm happy to look at, if there's a better rate out there, I'll take it.
yeah,
So
exactly. Yeah.
every 18 months is for our business model, is when we contact the customer, whether they're interested or not. We'll still contact them. If they're not, great, everything's traveling well for you, fantastic. That's how, when is a good time? Whenever the client wants.
Fair enough. All right, next question. Policy changes. Now, I don't know about this, but what was the recent lender government policy changes borrowers should be aware of? So has there anything been
Well,
changed recently that people need to know about?
nothing major. Nothing that would prevent anyone from applying that they couldn't have a year ago. Things have gotten harder, right? Obviously,
Yeah.
things have gotten harder. RBA has increased the cash rate. Obviously, banks pass that on straight away because the house never loses.
Mm.
So lending is getting harder, which obviously ties into the other, question about rent vesting, why people are doing that more now than ever before. But in
Mm.
terms of just straight policy change, not really. Banks are pretty
Mm.
well cookie cutter. They don't tend to, you know, drift outside their lines very often.
Fair enough. Loan structures. I'm not too sure about this question. So, what are some loan structures that people might overlook uh, and that you could
Yeah,
do to
probably.
increase borrowing
Yeah,
power? I don't know
probably
about that one.
touched on that. Yeah, probably touched on that already with the fixed versus variable.
Yeah,
Um,
yeah, I think so.
that there isn't. Look, a lot of people, especially on Instagram, will tell you that there's all these secret recipes in order to save money and do this and do that. There isn't. Right?
Mm.
Yes, of course, you've got offset accounts and redraw accounts in which you should use, and if clients aren't, then obviously that's where a broker can really help educate you on the importance of that.
Yeah,
But you borrow money, it's got an interest rate, you've got to pay that money back. That's about as simple
yeah,
as it can. There's different there's different ways in which your broker should be structuring your mortgage to help minimize that cost. But other than that, not really.
fair enough. Okay, last question. Future outlook. Where do you see the mortgage industry heading over the next 3 to 5 years, especially with AI and digital lending? That's a bit of an unusual one, that one. I don't really know much where that's happening myself.
Well, I
You got
guess
any
the answer
insight
to
on
that
that one?
is, who knows what AI is going to do over the next 5 years. I mean, I'm
Yeah.
blown away with how far it's come in 12 months.
Mm,
What even 12
yeah.
months into the future, who knows? But I guess what I
Mm,
can answer on that is that everything, especially for the younger generation too, who just seem like they're a little bit more competent with technology, it's going to get easier, it's going to get faster, and it's going to get more accurate. So, you've got lots of different. We use AI programs now for bank statements collection.
Yeah.
And it goes through and it scrapes your bank statements and it categorizes your expenses. So there's one addition that, and that's now basically mandatory. It's very close to banks mandating the use of what's called open banking. So that's one change that banks are enforcing that's already basically come in. Where they run with that, banks, I don't know. As I said before, the house never loses. They will continue to implement methods that obviously make their life easier with assessment and, data scraping. So where is it in the next 3 to 5 years? Hopefully easier than it is today, because, even the best mortgage broker, you've still got to jump through a lot of hurdles that these lenders, set for us. So I'm hoping that the more AI is implemented, the easier it can make the experience for the customer.
Yeah,
I believe brokers will be around for a while yet. I think that a lot of people are uncomfortable with chatbots or doing things themselves. Like there's online lenders now that anyone can Google and do a home loan application. I've still got lots of clients that much prefer to talk to me on the phone. So I guess it comes down to,
I was going to say, I think I agree with that one. I think when it comes to money and
exactly.
it comes to real estate and things like that, to be honest with you, I don't think we're all going to be replaced tomorrow with AI, because
I don't think so.
When you're buying a house, it's the biggest thing you're going to buy. When you get the finance, it's your money. So, and money's important. So do you really want to leave it up to a machine that, it's not personal? I think you need to have the personal touch, and you need to do business with a real human being, that kind of thing.
Yep. Well, there's still a lot of concern out there.
Fair
yeah,
enough.
well, there's a lot of concern about
no.
different 100%. And, AI is not perfect either, right? And there's still a lot of data breaching, and there's a lot of, scams out there too. So when that will, who knows, maybe in 5 years, it'll be a completely airtight AI process, and you and I are wrong. But I still think the average Australian would prefer to put a face to a name than talk to a chatbot online. And I know my clients anyway, are probably a little bit too friendly with my clients, too matey, but I actually enjoy talking to my clients. Yeah, I enjoy talking to them. It's not.
But that's the culture at the end of the day. You want to be friends with your clients. You don't want to be standoffish and too corporate. I don't think anyway. I think it's better off being friends with them, and not saying go down the pub with them every night or anything, but Well,
hey, that wouldn't be bad either. But I've still got clients from 2017, when I first became a mortgage broker in 2017. I've still got clients that have followed me from WA through 3 different employers and now to my own company. So
there you go.
I don't know if that retention rate would be the same for a chatbot. People enjoy talking to people. So
exactly. Yeah. Cool. All right, great stuff. Well, we better wrap it up now, because we're about to run out of time on this. So, Gareth and Ty, thank you both. I shall end the podcast there. I really appreciate your time. I think it's gone really well. So thanks again, and we'll catch up again soon.